Hello, friends. Welcome to the Weekend Investing Daily Bite of 13th of March. Today was the last day of the week, tomorrow being Holy holiday. So, wishing all the viewers the best of Holi and wish you have a safe weekend. Uh, Today, we are going to look at some data points which may point to, is this decade going to be different from previous ones? How markets used to behave earlier, now, and now how this current decade is behaving. We'll look at some data points there. Um, the disclaimer is to be read fully, please, and do subscribe to the channel if you haven't so far. Nifty making no headway on the higher side, just about stagnant minus 0.33% for the day. There is no news really to give on Nifty. Nifty Junior also down 0.5%, although first half of the day it did look like some positive move may come. That did not happen. Mid caps down 0.6%, small caps down 0.69%. So across the board, markets losing about 0.5%, except banks, which actually did rally in the morning but closed absolutely flat. Gold is up 0.35%. Gold is heading for a new all-time high close. As I record this, it's nearly 87,000 on gold price. Market breadth mostly biased towards the selling side. Not much to report here. Heat map basically red. No deep gashes, but 0 to 2% kind of moves on most stocks. Nifty Next 50 had some green, Adani Green, DMart, VBL, Bank of Baroda, but this also had significant number of mild losers for the day. Sectoral trends, you had real estate moved down 1.8%. Media, auto, metals were also down. Rest, all sectors were flat, and defense moved up 1.2%. So this has been a surprise this week. 2.5% on defense stocks. The last 1 month is even on defense now, although 3 and 6 months are still down. On real estate, we've lost 5% this month and 26% in last 3 months. IT stocks continue to go down 0.5%. These are the biggest. The sector is the biggest loser in the last 1 month, 5.3% this last week also. So no great, news from any front. Defense mildly up. Some of the stocks like data patterns, solar industries did well, but really speaking, not too much of gains on any such stock. However, what needs to be noted here is that the sectoral pattern is very different from the rest of the market, where market is trading near the lows. Here, it has bounced very hard, almost 12% from the bottom, and is stabilizing there. So it does seem like defense stocks are not so weak versus others. Let's come to the main data point for the day. So is this decade going to be different from previous ones? So some questions in most investors mind always remains is that, are we in a structural downtrend, or while the small bounces that are happening each time are these mere bear trend bounces and so on. And if we look back in history, we need to learn from history how markets have behaved in the past. When will they find a suitable support zone, and so on and so forth. So to give you context, just in the last 2 years we've had several corrections, mild corrections although, and we are currently at about 15%, especially on the major index. So we are looking at Sensex in this chart. We are currently at 15%. An 18% correction will take us to about 70,000. A 26% correction will take us to about 63,000, and a 33% correction would take us to about 57,000. All within the realms of what can happen in a extreme situation. Now, we are also staring at two consecutive quarters of negative performance. So, assuming that March is continuing to happen the way it is, we've not had two consecutive quarters since 2015. I mean, that is the kind of strength that has been there in the markets, that even in an episode like COVID, all the pain was, consumed within 1 quarter, and then the next quarter onwards we were up and going. Here as well, in 2022, we had 1 quarter down in slightly bigger way. But it was only in 2015 where really we had, for instance, 4 quarters of negative growth. So entire year actually, 2015-16, you can say, was spent in downward mode. We are currently on the second negative quarter. So what we are seeing now has not happened in the last 10 years or so. That this gradual but very uh, consistent fall is happening in the markets. So consecutive positive and negative quarters, if we want to see in the last 40-45 years. So this data is there where you can see that while we are right now at -2 negative quarters, the same happened in 2015. Prior to that, 2011, 2008, and so on and so forth. So earlier you can see every few years you had this phenomena that markets used to go down for a couple of quarters or more than 2 quarters. And of late, in the last decade, that phenomena went away, where you had down years and consecutive down years. You can see this in the chart. They were lumped mostly from 1990 till 2005, and then, or few every few years, 2005, 2015. But from 2015 onwards, there has been virtually no down years. The upside positive quarters have been plenty and spread across, and pretty reasonably consistent, I would say, across the last 40-50 years. So total 183 quarter study that we did, 60% were positive, 40% was negative. So this itself is telling you that there's a good chance that any consecutive quarter is positive or negative is almost an equal chance. 60% positive, 40% negative. Uh, and of these 183 quarters, you had 72 which were consecutive positive, and only 32 were consecutive negative. So it tells you that whenever we have a positive quarter, there's a higher probability that we will get another consecutive positive quarter. Whereas when we have a negative quarter, there is low probability that we get a consecutive negative one. But this time we seem to be headed that way. So that even makes it even more low probability event. And to that, my mind says that perhaps expecting a third quarter of negativity is very, very low probability. So at the end of February, I was expecting March to be positive, and there is still chance for that. I mean, we are still half a month away. But in case we don't, then the prospect of April becoming positive becomes very, very high. Strong bull runs are naturally followed by sluggish phases. So this is normal market behavior. Uh, what most people are focused on is the fall from 52-week high. 40% down, 50% down, most of the stocks. But we should also be rationally thinking about where the market came from and how high did it go. So if, let's say, your normal run rate was 14%, 15%, but you did 25% consecutively for 3, 4, 5 years, then obviously you are very far away from the mean. And when you will revert to the mean, you will come back to where you possibly were supposed to be, but the fall from the 52-week high will seem very steep, and that's exactly what is happening right now. If we see the seasonality effect of returns, then we can see that in the last 45 years, the first quarter is usually much weaker than the rest of the quarters. So quarter one, January to March, in the last 10 years, average is 1 -1.5%. Last 20 years, average is -0.7%. Last 5 years, average is -5.1%. And that's what is happening this year as well. Um, Second quarter of the year, calendar year, April to June, um, the average is much better. And in the last 5 and 10 years, we've done very well. Third and fourth also similarly. So there is some seasonality to January to March also because of year ending and people putting up advanced tax and all those kind of things. In addition to whatever else is also happening in the market. So downward phases have also gradually diminished. So if we were to see how many consecutive drawdown days are there in the market, then you can see that in the last 5 years, this number has really shrunk. I mean, uh, how many consecutive drawdown days are there where market doesn't make a new high? We are currently at only 116 days, but in the past, for instance, post Harshad Mehta period, you went to as long as 1100 days before markets made a new high. So the last decade, you can say this that number has been coming down, and for the last 5 years, 6 years, that number is really really very low. So it does give you some sense that the markets are not allowed to go very deep down in the last so many years, maybe because of excessive flows towards the market, maybe because there's too much money that got printed during COVID times, and hence the deep drawdowns are not happening as much as before. Um, so drawdown durations have significantly reduced in the past decade. Investors now expect markets to recover quickly. So everything is, we are living in a world of quick commerce. We want everything quickly. Things should come to our house in 10 minutes. So why should drawdowns take too much time? That seems to be, also the expectation that the market is going down. That is okay, but it has to come back up very fast, and that's what's happening in the last many years. So, I mean, if you go back 20 years, long bear markets spread out over 3, 5, 7 years was not out of the normal, but now nobody can really think about such long bear runs. So, overall expectation, risk perception, all that has changed over a period of time, and especially in the last 5 years. Before 2013-14, corrections were deeper and they used to last much longer. Of course, also the retail push and the DIs have been highly resilient, and that is possibly the reason why the fall has been very, I would say, you know, it's a very orderly process that has happened this time. I've never seen stocks go down 50% and not hitting too many circuits, etc. So few panic days are usually the case, but here in the last 4 5 months, while there have been some heavy selling days, it's not been like the washout days of the past where half the market is down on circuit, or the market itself is hitting a circuit. Those kind of days seem to be getting over, and recoveries are becoming extremely fast, and the duration of those recoveries is also sort of much lower than before. So uh, these are sort of anecdotal evidence of how the nature of the market to some extent is changing in this decade versus earlier. Maybe there is much more money on the sidelines now to absorb the selling when it comes down, because all asset classes are now sort of in sync. Gold goes up, real estate goes up, stock market goes up, everything goes up together because money, base money, is also going up. This never used to happen a couple of decades ago. It always used to be an alternate thing. When stock market used to go up, then no money used to go to real estate, or when real estate used to go up, no money was going to stock market, so on and so forth. So with corrections becoming thinner, these probably are opportunities. I would expect that this newer trend of not very deep and not very long corrections will happen, and that is also the global case. It's not just the India case that is working this way. So corrections in general, of course, are healthy. It's a breather after a sprint. You will need some phases in the market to wash out the excesses that get built. So stocks will become overbought. They will get reduced back to normalcy, and then they may become underowned, and then maybe a new phase may start there. And of course, every step of the market is like two steps forward, one step back. So accept that, because that is the nature of the market move. We will rarely get a straight run for very long periods. um, the 2020 to 21, and then 23 to 24 were those periods where we did not see a big dip during those two phases. Usually what would have happened is you go very sharp up and then a big dip and then go up. So even the 2003 to 2008 had very deep gashes in 2004, in 2006, and you really had to have a proper strategy to make sure that you were taking full action in that bull run. So stay the course, don't stop your sips, don't quit the gym after one tough workout. I mean, stay consistent, long term reward will follow. There is enough history that we have in our markets to showcase that there is a very high probability that if you don't give up the behavior of regular sipping or staying with the strategy, the market won't be doing anything really bad to you. But it's usually us that we become the enemy of our portfolio. We take some very rash decisions either at the top or at the bottom, and that creates a lot of mess in our own portfolios. So let me know in the comments what do you think about this, where the next quarter is going, whether this quarter is going in red as well. And thank you so much for watching. Once again, I wish you a very, very happy Holi and a safe Holi. Thank you so much, and see you in the next week. Bye.